playing out. And we're in this unique situation right now where each time we've hit these 100% measured moves, these Fibonacci measured moves on the charts, we've hit some here, we hit another one back over here, we hit another little one back over here. And this is what really makes you stand out and see the big picture of where I think we are for gold. Each time we hit 100% measured move and gold rally, gold pushed through those levels and shot higher with very little resistance. Each one of these, including the one we see right now, was 22 to 24%. And then we went into a multi-year pause or correction. And I believe we're entering into a economic kind of recession. I think we're going to have something like 2008 where gold pulled back 34%. I think we're going to see gold pull back substantially again going forward. And, from a big long-term point of view, I'd be very, very nervous to buy gold up here because I think you'll be able to buy it.
Gold has followed a consistent pattern. Each time it completes a 100% Fibonacci measured move, it rallies sharply by 22 to 24%, then enters a multi-year pause or correction. They believe we're currently at the end of another such rally and expect a significant pullback, similar to the 34% drop in 2008. Given this historical pattern and the possibility of an upcoming recession, the speaker warns that buying gold at current high levels could be risky. The speaker, Chris Vermeulen, a seasoned technical analyst, explains that recent tariff news has sparked a rally in risk-on assets, with investors dumping safe haven assets like gold and utilities in favor of high-risk stocks such as tech, energy, and crypto. While this shift has fueled bullish sentiment and talk of a new bull market, the speaker remains cautious. They view the current move as a bear market rally, or a dead cat bounce, driven by technical factors and investor over-optimism. They warn that this surge could be a trap before a larger market downturn. Chris explains that the current market rally may be another dead cat bounce, a strong but temporary recovery within a broader downtrend, similar to what happened in 2022. Technical indicators suggest momentum is weakening again. While some short-term bullish signals exist, investors are staying cautious and waiting for stronger confirmation before calling it a real bull market. They also note that money flows from defensive assets, such as gold and bonds, into riskier stocks, reflecting renewed investor optimism. This behavior is typical. When fear dominates, money flows into safe assets. When confidence returns, it shifts back into equities. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
There's no doubt the news really kickstarted the week. The tariff news sending stocks higher and making people want to run into the risk on assets. They're dumping. We're seeing gold fall. We're seeing utilities fall. We're seeing pretty much all the risk-off assets selling off in a big way, and they're moving into the riskiest stocks. People, I think, are kicking into high gear, thinking we're starting a new bull market, which maybe we are, but at this point, we're still in what I think is a dead cat bounce. And when we take a look at the charts here, David, there's quite a bit going on. There's definitely a lot going on this chart, and the biggest thing I think is. I think you and I had talked about this a few weeks ago, is that I was hoping this market was going to break this pivot high that we saw back in March and hopefully see it on big news. It would probably create some type of short squeeze that people who are bearish are going to want to cover. And it's going to get people really bullish. And that is exactly what you just said, is people now have gone from a bearish tone to a very bullish tone. And now suddenly the script has changed. Everybody who's thinking the markets were going down, or now all we're hearing is V-shaped bottom, new bull market has started. People are moving into the riskiest sectors. And I have a hot list that I keep track of. And what's interesting, if we look at the hot list, this is yesterday, all of the top performers ranked going forward are all the risky stocks, the ARK ETF, solar, Bitcoin, semiconductors, oil and natural gas exploration. We've got all of these very lucrative sectors. And when people pile in to all of these at the same time and they start to outperform and they work their way up this list, when, this is a sign that the market is people are bullish. Typically, it's a contrarian play. We saw the same more or less over here just before the stock market kind of went off a cliff. Everybody gets really bullish. Typically, you need to break some previous pivot highs. So the market came up and it broke a little bit of a high here. We saw small caps and micro caps and aggressive stocks do well. and everybody piled in just before it sold off. And now that's kind of where we're at again. And just the momentum, just on this most recent rally using a Fibonacci extension, we had this rally up, we had this big pullback and intraday reversal. And if we carry that forward, it brings us right to where we are. This is where I think you and I actually talked about this. I was looking for 5,900 as the upside target for the S&P 500, and now we've hit that, and now it's trying to figure out if it can push a little bit deeper. So the trend has kicked up into an upward trend. But in the grand scheme of things, I still think this is a big bounce and rally within a bear market. Now, we just have to wait to see if it rolls over or if we make new all-time highs. But from this standpoint, this is still a bounce, and it's sucking investors and traders in just before it's probably going to roll over, and I think head a whole lot lower. The markets have slowly been getting back to what feels like the norm: stocks up, bonds down, stocks up, gold down, and that's kind of what we've been seeing. I mean, gold and bonds have been moving lower every time we see the stock market move up, and it's pretty straightforward analysis. As people are coming out of defensive plays where they're like, oh, I think I'm safe here. And they're saying, now I want to move over to stocks and equities to take advantage of the upward move. And it's nice to see that kind of regularity, but I think it's just money sloshing. The stock market and all the different assets really is just a giant ocean of money flowing out there, and money sloshes from one asset class to the next. And wherever people think there's safety when they're scared, they'll move there. Gold and bonds. If they see that they want to ride a wave and they think the market's really bullish, they're going to move their money into a different asset class, so that everything's connected in a way. And so when one asset's coming down, that money's flowing somewhere else. And so we've been seeing it out of bonds, out of gold, and into more or less riskier stocks to take advantage of potential upside moves.
Gold miners have had a strong run recently, but they've hit significant resistance, and the rally may be over for now. Both gold and gold miners appear to have topped out. The speaker expects a correction, especially if the broader stock market declines. Chris compares the current setup to 2008, when both stocks and gold corrected heavily before gold eventually surged. If the market rolls over soon, gold, silver, and miners could all drop significantly. While these assets move together, gold tends to be more stable, whereas silver and miners are more volatile and choppy. Many investors believe dividend stocks are safe and low risk, but they often carry more downside than expected. During market sell-offs, dividend stocks can fall just as hard or harder than the broader market, as seen during COVID when they dropped 47% compared to the S&P 500's 34%. Despite offering steady income, they often underperform in recovery phases and miss out on significant upside gains. The issue is worsened by many older investors holding the same stocks and panic selling simultaneously. While dividend stocks offer great opportunities, especially during market bottoms, blindly buying them at market highs for small yields can be risky and costly. Now, let's look back at the interview.
Gold miners have had a really nice run. They've had, a rally up, a pullback, another measured move rally. They have recently hit major resistance, a very significant pivot resistance. It became support a whole bunch of times through here, then resistance. So there is no doubt, it's hit its move. It has more, I think, as well topped with gold hitting resistance. So gold miners, I feel like they're getting rejected. They felt like a little bit of a lot of people were piling into the miners because obviously they were moving up. But just like how I follow in trade sectors and stocks, you have to look at the indice itself, find out if the stock market, what that trend is doing, and then you use that analysis. So for the gold miners, I would look at gold and say, okay, well, gold has just put in what looks to be a major top. Gold miners look like they have also put in a major top, and they slammed into resistance. And just because they had a big percentage run doesn't mean it's the start of something much bigger. I feel like we're actually going to see a bigger correction in gold and miners. If the market does roll over and sell off here over the next month or two, miners are going to get beat up. Gold is going to get beat up. And a really good comparison chart actually is, I have charts of the S&P 500 weekly charts. The one on the left here, the candlestick background, that is the 2007 market high and the start of a correction. Well, we saw the S&P 500 fall about 20%. And if we look at today's price action and where we are, we saw this initial bout of about 20%. And, when you look at what gold has done, which is this yellow line, as the stock market starts to top, gold starts to take off and it continues to blow by and outperform. Well, we've done the exact same thing. The stock market recently pulled back. The stock market was putting in a top, and gold has shot higher. And, after that, the stock market eventually falls off a cliff and it fell 57%, and gold pulled back 34%. It eventually found a base and then shot higher, which is going to be the next golden opportunity, pardon the pun. But overall, we are in this unique situation where we have a very similar setup to 2008. And the biggest thing for, I think, people to see is I look at price action in the markets. This time around is very different than 2008. The tech bubble was very different than 2008, but stock prices do the same thing. When people are bullish, or they have FOMO if they're missing out, price goes up. When people get scared, they don't know what's going on, price goes down. It doesn't matter what the underlying reason is or the setup. It's just people are either buying stocks hand over fist or gold, or dumping it. And so I think we're in this unique situation where eventually the market is going to roll over and have a big sell-off and sell off and pull gold and silver down with it. And, gold and silver, they kind of move together. If I was to overlay the silver chart, you can see the white line here. It moves pretty much with gold. If gold is trending up and to the right, silver is generally trending up and to the right. You can see the same here where we are right now, that gold has been trending up and to the right, so has silver. They're the same trade. Gold, silver, and miners. The only difference is they have different levels of volatility. And, some of them, silver's noisy and choppy. Miners are noisy and choppy. Gold is a much more steady play, but that's kind of where I see us in the grand scheme of things of the stock market. Yeah, so this is a big. I think a lot of investors don't realize the risk that they carry when it comes to holding dividend stocks. Now, everybody's sold that get into a drip, dividend reinvestment market. You get dividends paid, you reinvest into it. It carries a lot of risk. So on the top chart here, I have the S&P 500. The bottom chart is the dividend stocks, dividend index. And more or less, if we were to just look at what the markets have done, and people think that dividend stocks have low volatility, they're huge companies, they got tons of cash, they're paying out dividends, they're rock solid. And while they might be, they still get hammered. And if we were to just compare, where dividend stocks topped out and where the S&P 500 is from that same period, you can see here, dividend stocks are down about 11%, while the S&P 500 is relatively flat. So the dividend is you got a couple small dividend payments in there, but overall you're carrying a lot of risk. When we look at the overall sell-off in the S&P 500 from the same level, the S&P 500 fell about 20%, and the dividend stock space fell also. So you have the same amount of downside risk. And when it recovers, it doesn't recover anything like the stock market does. And an even better view for people to kind of get a longer term perspective of this, let me just zoom out here. If you take a look at what's gone on from the COVID levels, if we were to take a look at how much dividend stocks fell, they fell like 47% versus the S&P 500, which fell about 34% is what it ended up falling. And so you carry a ton of risk. These poor investors, the thing is, the majority of the money in the market are like 50 plus investors. Most of them hold dividend stocks. They want the dividend, the cash flow, and they're told they're solid. The problem is when the same group of people all panic at the same time. They're dumping the same stocks. They're all the same dividend stocks. So they've taken all their money and they focus and they're just hammering away selling those dividend stocks. So you carry way more volatility and risk. And the real kicker is if you go from that same window to roughly where we are right now, the market is up, the dividend space, you're up about 4.5%, 5%. Well, if you had the S&P 500, you're up about 72%. So you carry more downside risk. You miss out on almost all the upside, all because you want to try and squeeze out an extra 3% yield a year from dividend payments. This is a couple examples, but it happens over and over again. Just go back to all the financial crisis, all the big sell-offs and crashes. Dividend stocks get beat up. Mind you, Dividend stocks, I've had some of my best trades with dividend stocks, but the thing is, you don't buy them up here in the nosebleed territory. We wait for a financial reset. And that's when you can invest into dividend stocks when they get beat up. In 2009, I bought a dividend ETF, just like SPYD. It was paying 16% dividend because the stock prices had fallen. They're still paying the same. Dividends are a great way, but you don't, going into them blindly thinking you're nervous right now and you're going to buy dividend stocks, just be careful. You're going to get a bigger haircut probably than the stock market if this market does roll over and crash. And that's what a lot of people, the majority of investors, have no idea. They're holding a ticking time bomb between dividend stocks and the buy and hold strategy. It's just a matter of time before one of these dips is way more than a dip, and it takes 5 or 10 years to come back.
Chris urges caution amid recent market optimism. Gold miners, and dividend stocks, often seen as safer bets, may be at risk of significant pullbacks, especially if a broader market correction or recession unfolds. Although temporary rallies and bullish sentiment have returned, these may be short-lived dead cat bounces rather than the start of an accurate bull market. Investors should be wary of chasing recent gains without considering the historical patterns, technical indicators, and underlying risks. Are you adjusting your investment strategy based on these potential market risks and signals? How do you balance safety and growth in your portfolio during uncertain times? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up and don't forget to subscribe to stay informed.